Good, good. Okay, now guys and everybody, I think I've talked to most everybody out there, and I know about everybody on the webinar here. So my name is Richard Zepp. I'm a VP of Sales here at Optimed, and welcome again. I'm going to do level funded and RBR training, and I really encourage everybody, if you have any questions, certainly you can raise your hand or stop me at any time. This is interactive, so I'd like to be able to get some feedback, get to know everybody here, and it's just us on here, so feel free to stop at any time if you have any questions. And I'm going to keep it moving along so we don't spend too much time in any one area. And again, I'm your Master of Ceremonies, Richard, and if you know me, you call me by Rich, I'm sure, and we're going to be going over, this is more of a working webinar. I'm going to be going over a lot of information, but specifically in certain areas to help everybody feel very comfortable in working with level funded plans, spec ag, and monthly accommodation. So we're going to get into some working models, and if you have any questions while we go through here, try not to wait till the end so we can all hear your questions. Want to get a good financial approach to your clients. And of course, at the end, I'm going to package this all up and go over a good sales approach that might help you feel very comfortable with level funded plans and reference-based pricing. Now, I should have sent out a poll for everybody, but if there's anybody out there that has sold any of these plans in the past, there's typically two types of self-funded. You have the open self-funded, which is usually for larger groups. We're not going to talk about that today. That's really unbundled services that is controlled mostly by the client, and they control their services and they go out one-on-one. We're not going to be talking about that today. That's usually for larger clients. What we're going to be talking about is level funded. And it looks and feels like just a regular insurance plan, but it's got some perks behind it. So we're going to talk about some of those perks. And this is what kind of sparked me to get into level funded years ago. And this was why. You can see the trends that are happening with level funded or any insurance product. Right now, in the last 10 years, the deductibles have been going higher and higher. And really all they're doing is offloading the risk onto the client to save money, to keep from these increases every year that are almost automatic. Everybody expects them. If you're lucky, you only get a 3% increase. Average increases are between 7 and 12% these days. You can see here, can you guys see my mouse there? 54% family premiums have been going up since in the last 10 years. So what has the market done for that? They've started to look at other products out there in the market. In level funding, let me ask a question. Hopefully you guys don't have stage fright out there, but is there anybody out there that has sold level funding currently? Does anybody not have stage fright?
Yes, I have.
Yes, I've sold it.
Okay. Very good. So this looking at level funded insurance, I know there might be a few people out there that have never sold level funded insurance. And so I wanted to give you some of the mechanisms within level funded that you might need to know. So when you go to sell it, you can give your client some security in changing over from a fully insured plan to a level funded plan. And we're going to be talking about aggregate, spec, and monthly accommodation and how that works. And I want to take you through a practical exercise here. And if you notice here, if you can see my mouse, you can see premium equivalent. A lot of people call, it's not appropriate to call, although we do, the appropriate name for your payment every month for a level funded product is really called premium equivalent, not premium. So let me put some numbers to this right now so we can go through a practical exercise on how level funded actually works with aggregate, spec, and monthly accommodation. So let's assume here that we got a product that's $500 a month. Any plan, $500 a month, and broken down the fees here. And we're just going to talk about the claims reserve. And as I set this up here, let's say we have 20 employees, $150 a month, putting in $3,000 a month total into your claims reserve. That's $36,000 a year into your claims reserve. And what's very important, when we take a financial approach to the client, we have to go look at the quote and we let them know that they have $36,000 that's available for them to get back. Now, we all know they're not going to get back $36,000, but we have to let them know to help sell the plan and help them to understand that this is really a financial decision. And then down below here, I have $10,000 spec. Now that's one of the, we're going to talk about how that works in coordination with the other three. But as you can see, let me just show you, a spec is for, it protects against large individual claims. That's what we're going to be looking at here shortly. So as we set it up here, let's assume that you sold your first level funded product. And for the first month, there's really no claims that come in. They come in, somebody might go to the doctor or something, but the claim will probably come in month 2. And so as you look down here, up across the top is the amount of money that's put into the claims reserve. Down here are the claims. So as we look at how this works, and you can see here, if you put in $3,000 a month to the claims reserve, and you got $2,000 in claims, cumulatively, you got $6,750. Can you guys see my mouse? Are you able to see that?
Yeah, I can see it.
Okay, good. So you got $6,750 in the third month, and you had $2,000 of claims in your third month, and you're running pretty good right here. So even though on the fourth month you have $7,000 in claims, you still have a positive claims reserve. Here you've put in a total of $15,000 in month number 5, another $3,500 in claims. You're still running okay. $3,500 here. You still got a decent claims reserve. But in July, somebody went to the church picnic and got into a beehive and you're allergic to bee stings or something. Okay, so somebody got messed up somewhere. You have a big claim. Now that's where your spec claim comes in. Remember I said there was a $10,000 spec? Now, in level funded insurance in different states, they have different minimum spec requirements. If we were to raise that spec requirement to a $20,000 spec, a couple of things would happen. One, you would increase the amount of exposure to your clients and your monthly rate would be down a little bit lower. The actuary will actually determine where your spec needs to be. But this isolates the client from a large claim. So that $40,000 above the $10,000 is taken care of by your spec. But still there's a $5,200, there's over a $5,000 less money in your claims reserve. Now where that's taken up at is your monthly accommodation takes care of that. So the further isolating the client from having to come out of pocket, because it looks and feels just like a regular insurance product. Next month there's $2,500 in claims and there's still light from that heavy claim in July. The $4,750 is now taken up by your monthly accommodation. And you run out the rest of the month and rest of the year, the plan year. And so what I did down here, I just put $1,750 and all that and ran it out for some small claims every month. But as you see here, the 22, all of this was paid by the monthly accommodation. So at the end, you can see that there were over $73,000 in claims paid. You only put $36,000 in claims reserve, but you still, the client, and this is the benefit of one of the benefits of a level funded plan. The client still gets money back, even though they had a shock claim in the middle of the plan year. In this example, they would get back $2,250. Now now when you go to renew, that's a pretty good thing to walk out and talk to your client about. You have a positive claims reserve and you get some, you and your client will have some decisions to make. Now, if this went negative and some portion or at some point during the year that you had a big claim or another couple of claims that sent you over, that's where your aggregate would come in. It takes care of anything outside of the 12-month contract period and would take care of that claim cost as well. So you have three kind of barriers around your claims reserve that helps you to isolates the client from any loss. So that's how it looks and feels, just like a regular price. Does anybody got any questions on that? Does everybody kind of get that? Does it make sense? I hope I didn't lose everybody.
Yes, yes,
Okay.
it makes sense.
All right, thanks, Kathleen. Okay, now, if you're lucky enough to have brought somebody home on their claims fund and you have the money, and there's two ways to get back the money. I get this question frequently, and I'll read it here. If you get a claims refund and it's returned to the employer and the employee contributed to it, they have to get back that percentage of their refund. So it just can't, if they get a large, think of it for a very large employer and they got a lot of claims, a lot of claims reserved back. The employer cannot keep that. By law, they have to give that back as a percentage of the return back to the employees based on their percentage of their payment for their premium. There are tax consequences to that because you put your tax, because you paid it with a pre-tax, you are going to have to pay taxes on that just like you would any other income. Now, what I always tell people when they renew is to simply take that money that was in there, where is it here? For this example, the $22.50, I would tell them to put that into their next year's benefits. You want to keep that money on the inside of a non-taxed product. And that's what I would counsel them with. It's nice to have money to be able to go along with your decision and buying your products for the following year. Reference-based reimbursement. Is there anybody out there that has heard about reference-based pricing or reference-based reimbursement?
Yes.
Okay, who's that? Is that Charlie?
This is Eric.
Eric? Okay. If you don't mind me, Eric, what have you experienced with reference-based pricing? You've sold this before? You've sold level-funded plans with reference-based pricing?
Yes, I have. In the beginning, it was a little rocky with the groups because they had to get used to the extra steps of calling in to the 800 number to get their claim approved ahead of time. But once they got used to it and got smaller out-of-pocket they liked it, and the employer obviously liked it too.
So they had to get their claims approved ahead of time. They had to get an approval to be able to go to the doctor?
Not to the doctor, but for the facility.
Okay, for a specialist? Okay.
Yep.
Yeah. And well, that's good. I'm glad you had a positive experience about it. Did those, if you don't mind me asking, did they stay on their plans? Was it a good experience for them?
Yeah, they renewed. So they've been on it for between 2 and 5 years.
Okay. Did they choose to roll their claims reserve into their oncoming year, or did they take their money back?
No, they rolled it into the incoming year.
Okay. And very good. Now, I neglected to also mention that with working with Optimed, that you get 100% of your claims reserve back. A lot of companies only give you 50% of your available claims reserve back. And one of the reasons they do that is on the front end of that actually lowers the cost of their monthly payment in some cases because they anticipate getting something back in the claims reserve. I do not like those plans that give 50% back. They're just a little bit of smoke and mirrors there, but they have their place. If you don't mind me asking, Eric, was your a 50% return or 100% return?
100%.
Oh, very good. Very good. Okay, well, RBR, and some folks, and I do get people that ask me this, what is the difference between reference-based reimbursement or reference-based pricing and regular old discounts from carriers? And this is basically it. When you get a carrier discount, and I think I was in my late 20s or early 30s, I happened to ask an insurance person because they came in and they did the walk around and said, you guys got a great plan. You got a 70% discount from the carrier, from the insurance company on your Blue Cross plan. And so I asked them, what 70% of what? Nobody ever knows what your discount is. If you get a 70% or 60% discount, it sounds really good, but who knows? It's from the ether, that nobody knows what your real discount is. And so those discounts come back, and there's no starting point. So every provider can have a different starting point for a discount. With reference-based pricing, it comes from the standard Medicare pricing. Now, I'm told that everything that's ever been done to the body has a price tag to it in a great big massive Medicare pricing data bank. That's where all the pricing comes from. So in reference-based pricing, the Optimed plans have 150% reference-based pricing reimbursement. And that is pretty industry standard. I'd say that's really good. That's a little bit below average. I think a lot of them are 175. I have seen some that are 125% of Medicare, meaning this. So whenever you go to the doctor and you go there for a checkup, that reference-based pricing, whatever Medicare will pay that doctor for that procedure or that checkup or whatever, is 50% higher. Though this plan will pay that doctor 50% higher than whatever Medicare would pay. And the advantage of that is that is typically less expensive than a deeply discounted PPO network. Now, I don't know this, and it's been a long time. It's been about a year and a half, but I heard that some PPO networks, and I believe it was a certain Cigna network over in the Northwest region of the country, they were 265%. On average, their claims cost was 265% of Medicare. And why this is a huge deal is because that's typically where your monthly premium equivalent is calculated. If you get greater discounts on your claims, you're going to get a better price on your premium equivalent every month. So the $500 example that we had back there, if that was a PPO network, I don't know, don't hold me to it, but that same thing, if that was reference-based pricing figure on maybe 20% higher on a PPO, give or take a little bit. But that's why, because your discounts that you're getting in your provider network are typically less for reference-based pricing than your PPO network. And that's why your pricing is substantially different. It's got set pricing, and here's the thing that I really want to kind of convey to everybody. When you're selling a reference-based pricing product, I hear a lot of brokers say, well, you don't have a network. Well, that's a big negative. You think about what the client is hearing. What do you mean I don't have a network? Well, gee whiz, what am I going to do? What you need to tell them is you can use any network. It's the same thing. You're not tied to any network. You call it open network, or you can use any network. Make sure you're talking to the client as a positive. If you're coming down as a negative, well, you don't have a network, it's going to spawn all kinds of questions. How do I know my doctor's on the network? How do I schedule with a doctor? All those things will come out. You need to be prepared to answer for them. Okay. Now, there are some benefits to a reference-based pricing product. Of course, it's cost-effective, it's lower than the PPO plans, but I want to talk a little bit about the challenges. We've talked about the benefits, and Eric, I know that if you sold a reference-based pricing product, you had to have a little bit more hands-on than you would if a regular old PPO plan was sold. Is that kind of a truth?
Yes, it is. Absolutely.
Okay. Yeah, so this is why I wanted to talk about these things, because if you're going to sell a reference-based, and I encourage you to do it because it saves a lot of money. And once the clients are on and they got it, and you get over the first month or two, it's really a great product. So I encourage all of you to, if you have not worked with reference-based pricing and a level-funded product, I really encourage you to give me a call. Some providers may turn you away, and this is why. When you walk up to the window and we've all done this, when we go to the doctor and we hand them the card and they don't see the Blue Cross on there, or they don't see whatever it is. Now, we sell Cigna PPO network, but let's just say we don't have any of those common logos on there that the lady on the other side of the glass is used to looking at. And they'll say, well, we don't take this insurance. You have to give it back to them and have them call the 800 number to verify their benefits, because they, more often than not, they will accept any, once the benefits are verified, more often than not, that person will be seen that day. Balance billing, we're going to talk about that, logo on the card, and who do you call if you have a problem? This is important. If somebody goes into the doctor and let's say the reference-based pricing price at 150% of Medicare, and that's and they go to bill out to the TPA, and let's say the visit cost $100. Well, let's say the billing department says, well, we always charge $150. We'll charge $100 to Optimed and we'll balance bill Susie or Billy for the other $50. If anybody gets a balance bill, they send it right to Zealous. And this is typically what happens. They'll call the provider and they'll work with them and they'll get that claim paid with no out-of-pocket costs. More often than not, that's what happens. But I want to impress upon everybody that Zealous has a robust way of handling a balanced bill, so that's not a problem. It is extremely rare. I mean, I only know a couple on one hand nationally that have ever litigated these types of claims. Typically what happens is if it goes to the next level, well, we're not going to accept the $150 because we're the doctor and you're not, and we're going to get $150 out of you no matter what you say. Well, if that happens, Zealous goes into their massive database, looks at all the claims for that region, and find out what's reasonable and customary. So if that service or that visit is typically seen by other doctors in the area for $150, Zealous will simply go back to the provider and say, you know, typically it's $100 or $125. They'll settle out that claim. That claim cost will come out of that cost of that claim will come out of the claims reserve, not the client, not the balance billed person. And the boss or the owner of the plan has to make that decision as well, because they're really the payee. That claims reserved for the client. So it's extremely rare to go past anything, to have anything balance billed to an employee. Eric, have you ever had to go through any balance billing issues?
Actually, no.
That's very good. That's good. And that means that your system is working. That's why I say typically it doesn't go past this, but your reference-based pricing partner needs to have this just in case, and that's very comforting. Now, and I apologize, the font's kind of small on here, but these are the cards. A lot of people wonder what logo is going to be on the card. It would be an Optimed logo. Now, I blew this up here. One customer service number, which is very nice. We do everything under one roof, so you'll have one customer service number for the client. They'll be able to call us if they have any problems. You don't have to call a bunch of people. Optimed has a ton of products. You can bundle a lot of packages, a lot of different products under one package for your client, and they'll have one number to call. It's very convenient and works very, very well. And also, if, for example, if you do have a gap plan or an overlying insurance policy, the one person can be able to go in that phone call, with that one phone call, look at both policies to see where you're at, what the problem is, and handle that. So it's very nice. And like I said, you have one customer service number, claims department, and of course, me, your humble servant, master of ceremonies, you have me as a point of contact for your sales. My job really, and what I enjoy doing, is working with brokers to peel away the onion a little bit, because each client is its own animal. You guys have folks that just have different personalities, different needs, different pain points. So I'm just a good resource for you to call me at any time. I want to go through the sales process. First, is there any questions out there, guys? Am I going too fast? Is it making sense to you? We good? Okay. All right.
Yes, we're good. I'm good.
All right. All right. Thank you, Kathleen. I wanted to make sure I wasn't putting everybody to sleep out there. I want to talk about the sales process. I have some brokers that have difficulty selling clients things that they should not buy. The first thing you should know is your goal is really to get the sale. That's the number one goal. And the other two number one goals are to get better coverage and to help your employer get some of their claims reserve back through good population health management, wellness programs, all of that stuff. It's important as you work with your client and you're working with a level funded product that you go in as a consultant, not just your basic spreadsheeting broker. Anybody can do that. Well, I'm going to show you a little bit of things here that are some tools that you can use when you're showing a reference-based product to your client. The first thing you need to do is pick the right client. Not everybody is the right fit for a reference-based pricing product. The low-hanging fruit for this, for you guys out there, is if you have some groups that are fully insured on a community-rated PPO plan. They're young, they're healthy, they are just simply paying a little too much for their health insurance. This is where we can really excel and save them at least, hopefully, at least 10% on their overall spend for their health insurance. Now we can go down and we can actually quote down to 2 people. I have never quoted 2 people on a level funded plan. However, I am up for the challenge. If anybody has 2 people that wants to take a look at a level funded plan, I would enjoy quoting 2 people on a level funded plan. I don't know if it makes good sense, but we'll look at it and we'll see if it does. Our carriers allow us, our underwriter said we can go down to 2 people. I'm shocked, but that's what they said.
Does it have to be 2 employees that are not employees, husband, wife?
It can't be husband, spouse. Or it can't be a spouse. It's got to be 2 individual employees. Correct.
Okay.
Yep. I have never sold one of those. I'm anxious to do so. I do want to look at when we put in the quote, if anybody wants to do that, float me something. We'll work on it. I do want to see what the rates come out at. I do want to peel away the onion and see every single thing that it will benefit us once we get the quote back. So please, let's press it. Let's do it. Our sweet spots between 10 and 25, 35 employees. Certainly we can go up to a zillion people, but the sweet spot is typically the under 50 crowd. That's where our rates are set at being most effective. So if you have small groups in that area that fit this, and again, healthy young groups, that kind of thing. So here's when the community rated plan, when you look at your PPOs, and this is exactly what's happened. I think I'm just reviewing for you guys, but unfavorable ratings, you got a small group that's sick, they have an unfavorable rating, they got problems, a chronic, maybe a little old, a little senior, they're going to see a rate decrease on average. In other words, not year to year, but the rates are going to be pretty reasonable because they're in a community, because the folks over here on the right-hand side, they're really subsidizing the unhealthy groups in that community. So they come out with an average rating. And so the really sick groups get great rates. The really favorable or the really healthy young groups get unfavorable increases in rates because they're grouped in with everybody else. This is really where you want to hang your hat for a level funded product. Look for those groups that you think they're being overcharged for what the demographics is for that group. How do you get a quote? Most of you, I'm sure, you're in the insurance business. We all have to go through these exercises, but if you want to get a quote for a level funded product or anything, we start out with a census. These are the things on the census. And one thing I really want to stress to everybody is I always ask this of my brokers: what are the pain points for the client? Is it price? Do they have an unhealthy person in the group they're trying to take care of specifically? Is it service? Has somebody pissed them off? I mean, find out what the story is. Because what's going to happen here is when you send me a census, I'm going to ask you for their current plan design. Because if when I go in there, and I'm going to talk to you about this, what plans should we quote? We have 12 plans we can quote. I'll show them to you here in a second. But do we want to quote the same exact thing they had last year? Or can I get them a better health insurance product for less money? Of course, that's what they all want. But do they want to save money with the same product? We need that feedback so we know what to quote. That's very, very important to be successful. First, we go and get the census, then I'll come back to you with some illustrative rates. So I call it a street quote or a flash quote. Once we get that, then we'll go to underwriting, because this is without underwriting, okay? This is, when you get me this stuff here, there's no underwriting associated with it. We're just gonna take those people with that age, with that percent of gender in the group. We want to know what tier they want, employee only, spouse, child, or family, and what zip code they're at. From that, we can generate what's called illustrative rates. Then we want to move right into underwriting. If they like those rates, and you go back to them and say, I'd like to qualify you for these rates. And if so, we get personal health questionnaires. The personal health questionnaires will be emailed to you. You can do them online as well. Now, 2 years claims history for the larger groups, if they have it. Typically, groups under 100, you're not going to get any claims data out of your carrier. But over 100, I believe it's actually required of a carrier to give claims data to a client at request, and I believe they have 30 days to produce that. And if you're up to renewal, they will press your 30 days pretty hard because they know they're being shopped. So if you do have a group of over 100 and you do want to plan for a renewal and shopping those rates, make sure you start 60 to 90 days out to get your information. We don't want to go too far out because you got to make sure the personal health questionnaires are within, I believe, 45 days or 60 days of the start date. But we'll talk about that depending on the group. And then once we get all of that in, we get an underwritten quote. We're going to talk about it. If you have not sold one of these before, you cannot fail. I won't allow you to fail. We'll go over everything in extreme detail, as slow as you want. It's not that difficult. Once we get a quote, we'll be able to go over it. It's pretty simple. And then I'll explain to you what I would do for an approach, and then you take some of the good of what I said and package it as yourself. And we go in as a team. I'll just help you and support you the best I can. Now, I put together here a package that I kind of like myself, and this is what I've gotten out for a lot of brokers. A high deductible plus a gap. And of course, what I told you earlier, and the reason for that is I think it was 162% increase in the high deductible plans. It's just going through the roof because people can't afford their health insurance. So what I like here, this is just an example for noodling around here, just between us. I like the OptiMed 7350 plan. The max out of pocket's about $8 grand, but it pays for the doctor and pays for the specialist and pays for the drugs. Now, the reason I like this plan is because most of the time, unless you have a severe problem, you go to the doctor, maybe a specialist, and certainly you might have a maintenance drug or something. You get the something you need something. You go to the drugstore. It takes care of those maintenance things. Then you throw a gap underneath of it. Now, please take a look at this. Now I threw this off to the right. Now I like to quote 3 different gap plans. Now you got to pick 2 of the 3. You can't have, for a small group, we don't want to be managing three different gap plans. 2 is typically what And these can be different. They can be 750. They can be a zero deductible if you wish. But I like to put a deductible in a gap plan so that your employees own a little bit of it. They should not be going to the doctor for a nosebleed all the time or for a hangnail. And the reason is it keeps the cost down for your plan. Because remember, one of the goals is to get the employer back some of their claims reserve. Very important. So a high deductible with a gap. Now on the right-hand side, I put excluded here. But one of the things I'd like to encourage everybody, and I'm going to ask you a little later again, is to give me a call, and I'm going to teach you to do your own gap quotes. We'll get you scheduled in with the ops, and they'll be able to teach you how to go in the back office and get your own quotes. Now, in this particular plan, what I did is I excluded the mental and nervous and substance abuse. These things here, if you include them, they're going to increase the cost of your gap plan. Now, that's an individual choice. It's based on your clients and their group, their population, their employees. So these are the things that you need to decide. This keeps your costs down. And remember, the overlying plan right here covers your basics. If you want more things covered, if you want the gap plan to pay the $40 for the doctor visit, you can certainly do so, but it adds cost. And in my opinion, pick a $500 or $1,500 deductible, or if your client likes higher deductibles, put in a $1,500 and $3,000 deductible. So the net result here is really you have one underlying level funded product that has a very high potential based on claims of getting money back at the end of the contract year, but your employees have real live health care really at a low deductible. And that's just something I like here. Now, on your quotes, when you're quoting somebody, and when you're going through the sales process, look at your quote. Don't look too much at the numbers there. I just pulled one that I had in my files. But over here to the right, you look here, well, the expected claims. What has to be expressed to the client is, this is what's expected to be in your claims reserve at the end of 12 months, over $31,000. Based on employees coming on and off, it's going to change. It's not going to be that. But that's what's today, based on the employees that are going on the plan. That's how much money, and that's really the clients. And what you want to let them know is you're going to try hard to help them to be healthy. You know, you can add other products. This is where the green light comes in. And you tell them that they have $31,000 or $32,000 in their claims reserve, and they get a portion of that back, and they are able to apply that to next year's benefits. Now you got an invested partner in helping you to help them. It builds relationship and it's a little tighter than your just basic insurance plan that's a community rated plan out there, like from a Buca. So it gets you in, it allows you to sell more products. I threw this in here because I was talking to a broker earlier this week, and they kind of wanted me to go through a gap exercise. So I'll do this real quick. I just did this up today real quick. It's a little cheesy, but it's not bad. But who pays when? So if you got the gap, the deductible that we talked about, a $500 deductible, the employee pays that. And then you got maybe a hospital stay, and the gap pays that. And remember down here, I just threw this in here just for conversation's sake. The gap pays different things in through there, all the way up to your max out of pocket. Sorry, guys. All the way up to your max out of pocket. And then your plan takes over at that. So that's kind of the layers, and that's why they call it a gap plan, right in here. So hopefully that helps somebody. And these are the plans that we have. The OptiMed copay plans, they're out there. I would love to be able to show you the details on these. You just got to give me a buzz and we'll go through them. I'll send you a copy of them. And you got 12 plans. There are plenty to choose from. Not during the time here with COVID-19, and you know, we're in some really strange times, guys. Not a level funded product, a full blown medical plan is not always the right plan to go out there with all the time. It's one of my favorite. I grew up in it. I like it. But in these trying times, you know, they might want to go back in with some reduced coverages just to kind of get them through these struggles. I've talked to a couple of brokers that have had some real difficulties getting back out there, getting in the game. I want to encourage everybody to not get complacent. There are some other products that we have here. I'd love to talk to you about them. They are pretty comprehensive, all the way up from very, very skinny coverage with the MEC, and then all the way up to the level funded product here. So as you look through people that may be canceling, that kind of stuff, they might want to have something in place, at least for a period of time. Give me a call and we'll reason through it. We got a lot to choose from. So I encourage you to not just say, oh my God, they're canceling and they're done. Go in there and help them through the time, and you know, take some of these products with you so that you know how to help them to get at least something.
Can you tell me, I have a question. I'm sorry, I have a question. For the street rates, the illustrative versus the final proposal, especially in the groups you said, you know, 10 to 25 is your market and there's no claims experience. So are you just requiring form fire? I mean, I'm thinking like individual applications. Do you have something?
Regular personal health questionnaire.
Okay, and then is there anything in form fire that's on your paper, or you accept any paper in order to write it, so we're not having to have the employees recomplete forms?
That's a fantastic question. What I would request that you do is send me your personal health questionnaire that you're using, and let me send it up to the powers, because some personal health questionnaires are very thin. I've seen some with like 5 questions. I mean, and others are a book. It's all comes down to what the underwriters will accept. Now, what can happen here is we can use, now I've double checked, I'll get back to you, but what we've done in the past is we use your form, and if you accept everything, there's another form that you got to fill out at the end to accept it, to make sure that the underwriters have gotten the proper information. But I'll make sure on your specific circumstance. So if you reach out to me afterwards and make sure I got your email and stuff, shoot me over that personal health questionnaire and I'll make sure that you get the exact answer, okay?
All right, and then the second part of my question is, you showed the alternative options, your MEC Edge or whatever. Are those available for all size segments, or do you have to have 50 plus to have these products?
Oh, no. Oh God, I hope my boss isn't on here. I think it's down to 5 or 10. I think it's down to 5 or 10. I should know that. I believe it's 10 if I had to guess.
And is your MEC Preventative a self-funded product as well, or is it a fully insured?
No, that's self-funded as well. Now you can get that as you can get reinsurance on top of that. That's an extra $2 or $3 per. I think it's like $3 or $4 per individual extra. That'll put reinsurance on top of it, which would make it fully insured. But I have to stress that we've gotten back almost all of our MEC people. I think it's extremely rare because the utilization on a MEC is so low. It's extremely rare for a client to come out of pocket to fund their MEC. Almost everybody gets their claims, a huge percentage of their claims reserve back on a MEC. It's very thin.
And I want to make sure that MEC is the MEC Edge, the enhanced MEC, as well as the minimum value. So it's different than your limited plans.
That's correct. Now the minimum value coverage is a bronze plan. That's a level funded plan as well. That's that's just a thin level funded plan. Low end level funded plan.
All right, thank you.
Yeah, no problem at all. That was a great question.
Hey, Rich.
Yes.
Hey, this is your boss.
Oh, yeah. Oh, okay. All right.
Yeah, hey, I was listening. Hey, good job. But I just want to have some clarity. So, Usually on those health questionnaires, we need to be within 60 days of the start date of the group, the enrollment date. So we can usually accept most, questions. You just got to look at them. So Rich is right about that. And then we just also need to make sure that there's 60 days. They've been done in the past 60 days before enrollment.
Well, that's a good comment on the 60 days. I would look to your underwriting to maybe expand that to 90 to 120 in light, literally right now, of what's going on.
Yeah, no,
trying to get
you're correct. You're correct. I mean, we've gotten a lot of exceptions done. There's new rules coming out on this stuff almost like daily. I mean, it's all the Cobra and everything that's going on. So yes, I mean, it's unfortunately going to be a case by case basis. It's just a shame.
No, that's understand.
The other thing was we were talking about MEC and the number of people enrolled in the MEC plan.
Yes.
Was that the question?
Yeah,
Yeah,
I
so
know some carriers require 50 employees to even offer that type of a program.
We do go down to 10, and there are, if it requires aggregate stop loss insurance on it, then there are some state regulations that, like in California, you have to have a minimum of 100. Florida is now 51. So there are some states, but generally 10 is the rule for just self-funded. Okay.
Okay, so since we're in a border state, what about for Ohio and West Virginia?
Ohio and West Virginia. Okay, so Ohio
I can look them up, Gary, if you wish.
What's that?
I can look them up if you wish.
Yeah. I'm looking at Ohio, and it says 15 plus, so I imagine that's with aggregate. And then no, it's 15 plus in Ohio, and then in West Virginia it's 10. And
Right.
with ag, in Ohio it's 25, and then West Virginia is 25.
Yeah,
Okay.
we can go down to 10, but I think that's the lowest that the carrier will allow us to go down to. But state rules will mandate on a level funded product how many people there has to be, how many eligible employees there has to be. So, for example, and you can correct me if I'm wrong, Gary, but if you go out to New York State, you have to have 100 eligible employees. But as long as they're 100 eligible, you can actually write a MEC with 10 employees on it, but they have to show that there was at least 100 eligible employees in order to write a level funded product for that state. Same thing with New Jersey. I believe it's 50. It goes by eligible employees.
Yeah. I mean, you're correct. It's like I tell everybody, just give us a shot, because a lot of these things change. I mean, MEC is now covering the COVID test. At least we've been instructed to cover the COVID test by the CARES Act. And so I would think that, if we could get exceptions to rules, knowing that, these states want people to have access to the COVID testing. So they probably waive some of these minimums on us. So back to the earlier point, a lot of things are just a little bit up in the air and shifting sands. But we'll work with you and give you the best information we can at the time.
Okay, thank you.
You're welcome.
What state are you in, if I might ask?
I'm in Ohio.
Okay.
And I know carriers are not selling this product right now because of the uncertainty of what you talked about with requirements of COVID testing and other things.
Right.
So they put a pause on this product.
Yeah, I have a slide in here about COVID-19 just for conversation's sake. It's a couple of slides back. It has certainly sent the underwriters for a loop with the federal mandate to do this, because they got to make sure everything's actuarially sound. That's really what it comes down to. So, well,
Yeah,
well thanks, Gary.
We're still comfortable writing it.
What's that?
We
That's good to know.
are still comfortable writing it. We haven't had any notice from anybody
Well, that's good.
telling us not to write it. I think that was an initial reaction. Lasted for about a week, and then it all died down for us, anyways. There's a lot of don't write this, don't write that, stop here, and then it all calmed down and says, okay, back up. You start to do things like Louisiana. We got to notice, don't write anything in Louisiana. And then like 2 weeks later, okay, Louisiana's good. And so it's just been all over the board. So which I guess everybody understands. So just we'll work the best we can.
Yeah. Well, thanks, Gary. Anything else on that? Any other questions? Is that okay? Okay, a couple of where are we at here? Let me get this going. Okay, a couple of questions for the team. Picking the right plan for your group. If the people are old and they have a few sick on there, it might be best to keep them on their existing plan, because if we go through underwriting, as many of you know, if we get personal health questionnaires, PHQs, that look like everybody is on hospice, it's not going to go well. They're going to get rated accordingly. However, to kind of offset their cost, I would recommend that you consider increasing their deductible like everybody else does and putting a gap in there, and then looking at a total analysis on their healthcare coverage and their overall cost. That might help. And again, I wanted to throw this down below of what our gap, some of these options that our gap has. And I've actually had this a couple of times. If anybody would like to chime in, I'll give you an opportunity to kind of think about this for a second. What if all the employees are young, but the owners are senior people? Now, I've had a couple of groups come to me, and they were small groups of about 15. Everybody was 35 years old and under, but the owner was senior and wanted to stay on their health care plan. Does anybody have an opportunity? Does anybody want to speak up and kind of tell me their experience that they might have had with somebody like this? Has anybody seen this before? No way. I'm the only one on the planet that's seen this. This is what we did. If the owner wants to stay on the company plan, what we've done is we've asked the owner to consider alternatives to their health care. First and foremost, they should be on Medicare, and then get them a good Medicare supplement plan that helps them. Of course, it's their company. They can do what they want. But if you have a younger company and then you have a senior person and a spouse that's sickly, and that is what is inflating your small group cost. So go in as a consultant and have them consider alternatives to get off of their plan, save them a ton of money, the amount of money that they would save collectively for getting their employees on a younger, aggressively priced, reference-based pricing plan would more than offset the cost for them to be on a great supplement plan with Medicare. That would be my recommendation. But of course, it's their plan. They got to decide what they want to do. And then you can put in a couple of gap plans in there with a high deductible, and they would get some great coverage. Here's the COVID-19 slide I was telling everybody about. This is the mandate that was effective on the 18th of March. Whether you're self-insured, fully insured, grandfathered, non-grandfathered, you must cover the COVID-19 testing and related services without cost sharing. That's why the underwriting teams, what Gary was talking about, we're watching the pricing as they move, and we're seeing how that applies to what our folks are quoting currently. This applies for the duration of the public health emergency. So, and the last statement, they're currently slated to last through July 24th, And of course, this is a great statement, unless ended earlier or extended, which means that July 24th doesn't really mean much. So they're going to keep it on as long as they feel it's necessary for the Health and Human Services. So as the underwriters try and chase down what it costs, what the risks are, and how to properly price the plans, you can look for some uncertainty in the market, as Gary has articulated. So
I have a quick question. I was just going through one of your proposals, and in the bottom part of it, it says, group is aware phone calls will be made to employees for health interviews. How often does that happen, and are you able to give employers a heads up to give employees?
on that, which plan do you see that on? What's that on?
The level funded product on your major medical plan contingencies, required information from underwriting.
Yeah, if they have any questions during underwriting, they may call directly to make sure that whatever's on that personal health questionnaire is accurate.
How often do you see that though? I mean, to us, oftentimes for us, we get questions from, like, it'll be filtered through us. We don't,
Yeah,
it's not too often that we have the carrier going direct to the employee. So then we are able to.
Yeah, I can tell you, I have not seen that at all. All of the personal questions that I've ever had, they all come through me, and then they would go through you. They don't get calls directly. I think that's more of a generic cover everything statement. If we can't get some information through, what's that? Yeah, I think that's one of those generics. Everybody's pretty sensitive about the front broker yourself. Nobody likes to circumvent you, is basically the statement that I want you to go home with on this one. I'm very sensitive to it. It's very rare that I'll call a client, and I only ever do that at your direction. There are some people that I call to help manage things, but it's very, very, very rare. We just don't like to go around the broker. That's what it comes down to. So what usually happens is you get the personal health questionnaires, and then the underwriter will come back and say, okay, these 5 or 6 or 10, hopefully not 25 questions need to be answered. And that means that the personal health questionnaires were not filled out appropriately. So what I always tell everybody is this: hand them the personal questionnaires and tell them everything needs to be filled out, and please do not use hieroglyphics that we can't read it without an interpreter. Because some people's penmanship is so bad, it makes no difference if they filled out everything or not. Make sure it's legible, make sure it is complete, and make sure it is accurate. And if you get that, 90% of the battle's over. And then after that, it's just underwriting. But typically, what will happen is when an underwriter gets back to them, it's usually for half information. If they're on a medication that seems to indicate that there was a procedure or something, some underlying problem that's not identified in a personal questionnaire, that's usually when we'll get a phone call. It's not complete. Okay? But to answer your question very, very clearly, I've never seen the underwriters go around the sales process. Okay?
Yep.
All righty. And I wanted to let everybody know that our level funded plans, they are not just reference-based pricing, but we also use a Cigna network. Household name, very nice. So we can go with a PPO. At your direction, I will quote several different ways for your client. The question will be, have they ever been on a level funded product? Number one. If the answer is yes, then they're looking for another one. Then there may be no reason to go to a PPO. They're just looking for reference-based pricing. They've already been through that experience of being on a level funded product. If they want just another PPO product, we can certainly quote that as well. And OptiMed, and I just threw this in here, we got a lot of value adds. Once you start working with us, that's one of the really great things about us. We have a lot of value adds on there. You can read them for yourself. They go in at most products at no cost. Not every one of those products are at no cost. I just want to let everybody know. I've had that question a couple of times. They're really a value add for when you want to package your product. Additional products are right there. We have a lot to offer. So when you come to quote certain things, consider this, and this is very important. That's one of the great things about Optimed, because we are a robust TPA. We have a lot to offer, and the real advantage is you have one customer service number to handle your problems. Another thing you'll find with us when you start writing with us, unless somebody else has a different experience, I find it is extremely rare for anybody to have any major problems with Optimed in customer service. That is one of the top things I really want to stress. Plans are in, and they have very, very few problems. And occasionally you get the card thing, you miss a card or it's not out or something, those generic things, but they go out rather quickly. And once something's on autopilot, I have a group right now I thought was going to be a major problem every month. I get no phone calls. I even check with the broker once in a while because I expect something. Nothing. Everybody's happy, autopilot, and just away they go. So the more product that you can put under one customer service team that's doing that great of a job, you're going to sleep well at night. So that's my comment for that. Next steps, and please, you guys email me, and I would like to kind of meet everybody that has joined our webinar today and see if we can't do something together. We're coming out with being able to quote your own level funded product here soon. I'm very anxious to see it. I get rumors about it. That won't be long. I believe beta was already out, and I can't wait to see it. So it won't be long for being able to do that. Now, I'd like to get you trained to be able to do your own gap quotes. You'll be able to go right into your back office and be able to choose from several different carriers to do your own quotes there. I would encourage you to look at your current book of business to see what opportunities you have to optimize some of the, especially during this COVID-19 mess that's going on, to kind of optimize your current book of business. One thing that a lot of people don't know, I mean, I wouldn't encourage it too much, but you don't have to wait for renewal. If you know that there's a company that's paying way too much for their benefits, they don't have to wait for a renewal to get another insurance plan in there. Now, I wouldn't do it 2 months after they renewed. I'd wait to 6 or 7 months that they were in, so that they don't have to go through that hassle of reinstalling another plan. And lastly, let's do some quotes together. At least see where we stand. If you have a good census somewhere, let's run a few quotes up the flagpole and see where they come in. And then that'll give me the opportunity to work with you. And that will also give you the opportunity to see where you stand with your existing book, to see if there's any opportunities to improve their coverage and maybe save them some money. Also, by the way, I don't know if I had mentioned this or not, but level funded insurance, you can set your own compensation. Now, I recommend that you don't put $200 PEPM in there, but or 75% commission rate. We'll reason over it, but you get to set your own commission rate based on what you got now, how the rates come back, that kind of thing. So you get a little bit of control over your quote, which is really nice. Okay, any questions, anyone? Okie doke. Well, listen, I want to thank everybody for sharing this time with me, and take down my phone number there. You know how to get a hold of me. I would enjoy chatting with you at any time and going through a few things with you guys if you got the opportunity. So thank you very much, and have a great weekend, everyone. I'll stay on for a couple of seconds here in case anybody wants to chat. So take care, guys.
Thank you. Have a great weekend.
Have a great weekend. Brian, I apologize. Are you still there?
Yes.
Brian, I'm sorry. I had you muted the whole time. My apologies. I just saw
That's
that.
okay, Rich. Rich, I like this. I liked your presentation. I don't have a lot of experience in the self-funded. Our agency does, but my business partners do. But I personally don't have a great deal of experience on self-funding or level funding. So I thought I found this of value. Did you by chance record this and have slides?
Yeah, according to this session is being recorded according to the little red dot at the bottom of my screen. So yes, it is being recorded. Let me ask you, Brian,
Were you
since it's
planning on
just
distributing that?
yes, I can distribute this.
Yeah.
I have never done it before, but I'll make
Great.
sure it's done, and I'll make sure you get a copy of it.
Okay.
Let me ask you, Brian, if you don't mind, because I want to do at least one of these sessions a month. Since you don't have much experience in level funding, was this approach in this webinar helpful to you instead of me just downloading a bunch of information to you?
Oh yeah, I like the way the manner in which you presented it. It was very understandable. Just want to review the kind of the for somebody it's fairly new to still. Wouldn't hurt to hear it again. But I thought the manner in which you did it was easily understandable and interesting.
Interesting. Wow, that's something I've never heard of. Well, that's good, Brian. You
Well,
made
it is. I'm familiar with reference based and things like that. It's just I'm getting. I mean, I've always been skeptical about carriers and fully insured, but and now ECA, it's just getting worse and worse. I mean,
yeah.
I mean, I'm getting it's asking me all the time about ICRAs now.
Well, this is what I recommend for you.
They don't want to
Brian.
be in the game.
Yeah. Well, if I might make a recommendation to you, you got my contact information right there. Let's do this for you. Okay. I've always found that walking somebody through from A to Z it doesn't have to be a live group. If you don't have a live group, you can send me something and then I can show you the process on how that works and then some of the reasoning that I go through as to why I do certain things. I mean, you can float some kind of group to me if you want to, or I can just, and frankly, I own this PowerPoint. I can set up at any time and do you and the folks in your office and kind of tailor it to you and your folks. I mean, I'm really a resource for you, Brian. That's really what it comes down to. So
Okay.
you don't have to wait till the next time for me to do something to get trained or to help you out. So don't worry about that mess at all. Okay.
Awesome.
All right, Brian.
That sounds great. I appreciate it.
All right, Brian. Well, have a great weekend, sir.
Yes, and if you wouldn't mind, send me that. I'd like to listen to it again before I contact you again.
No problem. I'll see about getting that to you.
All right. Thanks, Rich. Have a good weekend.
All right, man. Have a good weekend. Thanks for attending.
Be safe.
All right.
Yep.
Bye-bye.